Hey everyone, and welcome to The Explainer. Today, we are cracking open a really fascinating set of financial numbers. We're zeroing in on HG Metal and their performance for the first half of 2026. If you're looking at this from an investor's perspective, there is a lot to unpack here about how companies actually navigate tough, unpredictable environments.
That's exactly right. HGML is a massive player providing end-to-end steel solutions, and their latest financial report tells a pretty incredible story about resilience. We're going to look at their income, their cash reserves, and, crucially, where they are placing their bets for the future.
But, before we really get into the weeds here, I want to set up the central mystery of this explainer. It's kind of like a classic business riddle. How exactly do you manage to increase your gross profit when you are actually bringing in less overall revenue from your sales?
I mean, it sounds completely counterintuitive, right? Usually, if your sales drop, your profits take a massive hit too. But as we're about to see, this company managed to pull off literally the exact opposite. It's basically a masterclass in why top-line revenue is really only half the story for an investor.
Okay, let's dive into this. The paradox we're looking at is striking. Their revenue dropped by 5% compared to the same time last year, but get this, their gross profit actually jumped by an impressive 21%.
Those are some seriously contrasting numbers. They brought in less money at the cash register, so to speak, but the money they actually kept after paying for the raw materials went up significantly. To understand how they pulled this off, we kind of need to understand what exactly it is they're selling.
To make sense of those abstract numbers, we have to look at physical reality. HG Metal deals in massive quantities of industrial materials. They have over 50 years of experience providing end-to-end steel solutions across Southeast Asia. We are talking about the heavy structural steel that literally builds cities. Exactly! And when you are dealing in a commodity like steel, your financial performance is incredibly sensitive to global prices. So when we talk about their revenue dropping, we are actually talking about the physical movement of steel beams and the global market price of that metal. Let's move into our first core area. Revenue down, but profits up. We really need to dig into these margins. Right, let's look under the hood and solve this profitability mystery. When revenue drops, an investor's very first question is always, did they lose customers or did prices just fall? Breaking down their 81 million Singapore dollars in total revenue gives us the answer. Their actual sales volume, like the physical amount of steel they sold, only dropped by a tiny 1%.
So the absolutely crucial point here is that the bulk of that revenue drop was simply because the average selling price of steel fell by 4%. The global market for steel prices has just been declining. They are still moving almost the exact same amount of product, they just have to sell it for slightly less because of the broader market environment.
But here is where it gets really good. Even with those lower selling prices out there, their gross profit margin leaped from 13.3% in the first half of 2025 all the way up to 17.1% in the first half of 2026. I mean, that is a massive improvement in profitability. How do they manage to pull this off when steel prices are falling everywhere?
It is a great question. Basically, if you are selling your product for less, the absolute only way your gross margin goes up is if your costs are dropping even faster than your selling prices.
And that leads us to their secret weapon, incredibly disciplined procurement. Because global steel prices were falling, HG Metal was able to step in and buy their raw materials for much cheaper. And they didn't just get lucky with the market, The management explicitly pointed to their disciplined procurement. They were very smart and highly strategic about how and when they bought their materials. That discipline is exactly what boosted their gross profit to 13.8 million Singapore dollars. This is exactly what investors love to see, right? Management aggressively controlling the variables they can actually control. Which brings us to our next section, smart spending and cost control, keeping the house in order. Because look, making a fantastic gross profit means absolutely nothing if you just spend it all on bloated administrative costs. HG Metal didn't just stop at buying cheaper steel, they looked inward, optimizing their own internal delivery fleet.
Yeah, by making their own trucks and logistics run more efficiently, they drastically reduced their reliance on expensive, outsourced third-party logistics services. And the result? They dropped their selling and distribution expenses by 8% compared to the previous year. It is just a fantastic example of finding internal efficiencies to fiercely protect your margins.
Let's see how all this builds into their final profit numbers. Their reported profit before tax was 7.2 million Singapore dollars, which is a slight increase from the year before, But honestly, the true story is actually much stronger than that.
That's right, because last year they had a very lucky one-time gain of over 2 million Singapore dollars just from favorable foreign exchange rates. This year, those currency gains were practically tiny.
Right. So if you strip out those totally unpredictable currency fluctuations and just look at the core beating heart of the business, their underlying operations profit jumped from 4.8 million to 6.8 million Singapore dollars. That shows their actual day-to-day business is performing significantly better than it was the year prior.
Moving right along to Section 3, strong cash and low debt. Let's check on that financial safety net.
The balance sheet is the ultimate reality check for any company, and this number is highly reassuring. As of March 2026, HG Metal is sitting on a massive cash pile of 55.5 million Singapore dollars. That is a whole lot of steel piggy banks.
It is a phenomenal position of strength, for sure. To have that kind of liquidity means they can weather unexpected macroeconomic storms, and honestly, more importantly, they have the dry powder ready to invest in growth opportunities without having to go out and beg for expensive funding.
And you absolutely have to contrast that massive cash pile with this next number. 4.4 million Singapore dollars. That is their total bank borrowings. Just let that sink in for a second. 55.5 million in the bank and only 4.4 million in debt. Their financial stability is incredible. In a high interest rate environment, having minimal debt means their hard-earned profits aren't just being eaten alive by interest payments to the bank. It is a very clean, very safe balance sheet.
Let's pivot to Section 4, investing in the future and expanding their footprint.
Because you definitely don't just want cash sitting around losing value to inflation. Investors want to see capital deployed smartly. HG Metal has two major strategic investments utilizing that strong cash position we just talked about. First, they subscribe to preference shares in a low-carbon steel plant in Malaysia called Eden Flame. Second, they are acquiring a brand new industrial property right here in Singapore at Tuas View Circuit. Both of these moves are entirely about expanding their production capacity and really securing their supply chain. They are basically using today's profits to physically build tomorrow's infrastructure. The Eden Flame investment is particularly fascinating to me. By late 2026, this facility is targeted to produce 500,000 tons of low-carbon steel every single year. This is a major strategic shift. The entire global construction industry is under massive, growing pressure to reduce its environmental footprint. By securing their own dedicated supply of sustainable, low-carbon steel, HG Metal isn't just expanding capacity, they are practically future-proofing their entire business to meet the green building demands of the next decade. Finally, Section 5, future risks and expectations. How are they navigating the road ahead?
Because no analysis is complete without looking at the downside, right? Fortunately, their foundation looks solid. Local construction demand in Singapore remains just massive. Projections show it hitting somewhere between 47 and 53 billion Singapore dollars in 2026.
That is a highly reassuring pipeline. The base level of activity in their home market is going to remain heavily supported by ongoing public and private sector projects. Basically, there is plenty of pie for them to take a slice of.
However, management also provided a very real list of external uncertainties that could weigh on their future margins. They are anticipating a softer overall macroeconomic environment, which could potentially slow down the awarding of new, future projects.
They also specifically called out rising energy costs and persistent geopolitical uncertainty. Look, steel manufacturing and logistics are highly energy-intensive operations. If fuel and electricity get more expensive, or if global supply chains get disrupted by global tensions, that fantastic profit margin we discussed earlier could easily get squeezed.
To wrap up our core analysis today, I really want to look at this quote from the Chief Executive Officer, Zhao Xiao. She stated that despite these external uncertainties, the company remains firmly focused on operational efficiency and long-term value creation.
And honestly, based on the numbers we just walked through, they are putting their money exactly where their mouth is. They are controlling their costs, protecting their cash, and heavily investing in sustainable facilities to secure stable, long-term growth, even when the market headwinds start blowing hard.
It is such a fascinating case study. As the construction industry goes fully green over the next decade, you really have to wonder, will traditional industrial companies that fail to make these types of proactive low-carbon investments simply be left in the dust? It's certainly something for all of us to keep a close eye on.
Absolutely. Well, before we sign off, please note, this content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice. Thank you so much for joining us for this explainer.